Okay, Chapter 12. In this chapter we are looking at the accounting for partnership income, as well as partnership investment and partnership liquidation. So Rose Tyler has owned and operated a proprietorship for several years. On January 1st, she decides to terminate this business and become a partner in the firm of Tyler and Sigma. So Tyler's investment in the partnership consists of $11,150 in cash. She also brings the following assets of the proprietorship from her old sole proprietorship: $14,420 in receivables, a $21,21 allowance for doubtful accounts, equipment of $20,370. That was the equipment's original cost, less its accumulated depreciation to date. The partnership has agreed that the allowance for doubtful accounts should be $3,182. And the fair value of the equipment, $12,933. Okay. All right, so what we need to do is record the investment of Tyler into her new partnership. The first thing that she is giving to or investing into the new partnership is the cash, so we will debit the partnership's cash. We also are giving the partnership or investing $14,420 in accounts receivable. Now, the old proprietorship had only recorded $21,21 as the allowance for doubtful accounts, but the two new partners have discussed and believe that $31,82 is a better allowance, so that is the one that will be recorded into the new partnership. We will credit the allowance for doubtful accounts for $31,82. Additionally, the equipment had originally cost $20,370. Back at the time when it was purchased by the old proprietorship and had accumulated depreciation of $38.60. However, we do not record at the old cost or its original cost. We're going to record at its fair value at the date that it is invested. So we will record the fair value of the equipment of $12,933. Right now, the total value of what Tyler is investing is all of the assets added up, less the allowance for doubtful accounts, and the difference is $35,321. And that will be the amount that we record as a credit into Tyler's capital account. In this next problem, we are going to look at the liquidation of a partnership. In other words, the partnership is ceasing to exist. So Frema Company, as of December 31st, has cash of $22,029, non-cash assets of $100,300, liabilities of $56,972, and the two capital accounts are $42,820 for Dalek and Briggs of $22,537. When the firm is liquidated, $116,600 in cash is received for the non-cash assets. Dalek and Briggs income ratios are 65% and 35% respectively. All right, so up here are the assets, liabilities, and ending capital balances that were provided in the problem. The first thing that needs to be done is we need to liquidate all of the non-cash assets. By liquidate, I mean we sell these in exchange for cash. So all of these were sold, so we're decreasing the non-cash assets and recording the amount of cash received when they were sold in the amount of $116,600. Ending up with cash of $138,629, which is the cash that was there plus what was received for the sale of the non-cash assets, increasing the new cash balance. There are no more non-cash assets. They were all sold. And there's a difference between the sale of the non-cash assets and the cash received. There was actually a little bit of a gain. Remember, gains are just like revenues. They will increase the owner's capital accounts. So the $116,600 minus the value or cost of those, there was a gain of $16,300. That will be split. 65% of it, or $10,595, will go to Dalek's capital account, and the remaining 35,705, or, let me go back, 116,300 times the 35% income ratio. Nope, sorry, I got a wrong number in there. 16,300 times 0.35, a little bit better. 5705 of that gain will go to Briggs based on their income ratios. Okay. So now that we have new balances of cash after the sale, the liabilities were not affected, and our new capital balances with the gains recorded. We will then take the liabilities. We'll use all of the cash to pay off the liabilities of the partnership. So all 56,972 are paid using cash, bringing the cash down to 81,657. No liabilities anymore. They were all paid off, and the capital balances were unaffected when the liabilities were paid. So those stay the same. And then finally, the last step in the liquidation process after liabilities are paid off is to just distribute the remaining cash to the partners based on their capital balances. Dalek has a capital balance of 53,415. We'll get 53,415 in cash. Briggs has a capital balance of 28,242, and we'll get the remaining 28,442 of the cash. All right, this last exercise has us working with the distribution of net income. So Martha and Jones have capital balances on the 1st of January of 58,000 and 43,000 respectively. The partnership income sharing agreement provides for annual salaries of 22,200 for Martha, 14,600 for Jones. Additionally, they are paid an interest of 10% on their beginning of the year capital balances, and any remaining income or loss after salaries are paid and interest is paid will be shared 60% by Martha, 40% by Jones. They want us to prepare a schedule showing the distribution of net income. And for this first year, we're going to assume net income is 70,300. All right, the first step based on the partnership income sharing agreement is to start with the annual salaries. The first thing that needs to be paid out is 22,200 to Martha, 14,600 to Jones. Of the total 70,300 in income, 36,800 will go to the two partners based on their annual salaries. Then the next thing will be if there is still enough of the net income remaining to pay the interest, that will be paid next. Total of 70,300 in income. We just paid out 36,800 of salaries, leaving 33,500. The interest payment is based 10% of beginning capital balances. If Martha's beginning capital balance is 58,000, 10% of it, 58,000 times 10% means Martha is to get 5,800 interest allowance. Jones should get 10% of her 43,000 beginning of year capital balance. So far 36,800 was distributed for salaries. The next 10,100 will be distributed for the interest. So far of the total net income, 36,800 for salaries, 10,100 for interest. 46,900 of the income is allocated is in these proportions. That means of the 70,300 less the amount already allocated, there is 23,400 of net income to distribute. The remaining income or loss after salaries and interest is distributed 60, 40. 60% to Martha. So 60% of the $23,400 will go to Martha, and the remaining $9,360 will go to Jones. Okay. So adding it up, out of the total $70,300 in net income, $42,040 goes to Martha, $28,260 to Jones. Now let's take a look at what would happen if, actually, let me jump over that. We'll come back to that in a minute. Let's go down and do the journal entry for recording this distribution of net income. Remember, when you close out income, $70,300 will be coming out of income summary because all revenues and expenses were closed out to income summary, which left income summary with a debit or credit balance of $70,300. To close that out, we will debit income summary. And then we will transfer that income to each owner's capital account based on the distribution up here. $42,040 to Martha and $28,260 to Jones. Okay. Now let's look at the second scenario where net income is only $29,000. We still have to go through the first two steps of the partnership income sharing agreement. We still have to distribute the two salaries to the two partners. Then we also have to figure out their interest allocations. So those don't change. They still are allocated the full salaries and the full interest. But by the time we get to this point, we have distributed $46,900. However, there is only $29,000 in net income to distribute, which means there is $17,900 less than what the salaries and interest income ratios are supposed to be giving each partner. So really what we end up doing then is reducing the allocation to each partner for the amount of the deficit. So the deficit was $17,900. The income sharing percentages are 60% Martha. So of the deficit, Martha will be allocated 60% of it. We will reduce her income distribution by $10,740. And for Jones, of the $17,900, Jones will be allocated 40% of the deficit, reducing Jones' allocation. So what we've done now is allocated their full salaries and interest, but then reduced it by the limit based on the amount of income. So we are still allocating $29,000 in net income, but we had to go through all three steps first. Okay. So the journal entry would be very similar to the prior entry. We will debit income summary to transfer the summary of income out of the closing account, and credit Martha for her share, which was $17,260, and Jones for her share, which was $11,740. All right, I hope this all makes sense. Reach out with questions if you have them.